All right, on that positive note, let's take the discussion forward with Sahil Kapoor of DSP. And in fact, Sahil looks at the macros and the micros very carefully and comes out with his monthly observations called Nitra. So I'll take the discussion forward with that. And the one particular point on everybody's mind, Sahil, is when is inflation peaking out? Are we getting concrete evidence that all the contributors of inflation, the CPI inflation, because Fed's action is dependent on that inflation, is peaking out? And because market will read that all those cues very closely, if not already.
So Ajay, in about 2 months ago, in the month of July, we wrote a report called The Coming Collapse of Inflation and How to Benefit from It. The title is a little catchy, but the idea was to look at three major things which are causing inflation. One was agricultural commodities, the other was the base metal and oil and gas complex, and the third was the housing market. These three put together in the US accounts for nearly 3/4, 75 to 80% of the overall inflation basket. When you look at the overall inflation basket and you slice and dice it, this is one way to slice and dice it. The other way is to look at two components. One is goods inflation and the other is services inflation. So these are two different classifications. Let's go to the first one. So there we've seen agricultural commodities, base metals, and somewhat oil energy prices, X of gas, all have corrected quite a bit. Okay, most of them are down between 25 to 40%, give or take whichever commodity you want to look at. The other is the housing market. The housing market is very, very special because it has about 42% overbearing weight in the US CPI, and about 32% of the overall CPI comes only from US rental market, which is the rents that people pay in US. We looked at the data very carefully. What we see is that rents in US peaked somewhere between March and April, and they started to come down. They were rising at a very, very fast pace. US home prices were rising at 22% YOY. Rentals were rising as fast as they can. In the month of September, for the first time, we've seen month-on-month decline in rentals. And this is a very clear indication that rentals are now sequentially and possibly in the coming months on a YOY basis going to decline. And then you look at all these numbers and put them together, there is a very, very good chance that by the time we enter the months of December, Jan, Feb, we'll see CPI readings which will be much lower. And the second basket, which is goods and services, which I mentioned, the goods inflation is already declining at a very fast pace because of a large amount of inventory being built both at the retail level and at wholesale level. Secondly, freight costs, which are now falling very, very swiftly. So if you look at the freight index, a 40-feet container freight index, which was at about $10,000, $11,000 at the beginning of this year, is now down to about $3,200 to $3,300. Prior to COVID, it was at about $1,300 to $1,500 range. So it's getting near the level, and I think most likely it will go even below that level. So services inflation per se hasn't really moved down. My guess is that it will try and create a peak in the month of December or so, and then possibly sequentially it will cool down. As of now, there are no clear signs that services inflation in US has already peaked. Services inflation plus rental inflation are closely linked together. So from whatever data I've told you, in conclusion, you could say that we saw CPI peak at 9.1% in July. Slowly and steadily it is coming down. The extent of decline or the momentum of decline will increase after November and December. And by the time you enter January and Feb, I don't think we'll be talking about inflation. Most likely we'll be talking about disinflation. The risk to this hypothesis is another oil shock or another energy shock or something uncertain that we can't look at right now. Yeah.
Sahil, World Bank just some time back put out an estimate that global trade is likely to grow by 1% in FY23. Just 1%. That's the extent of slowdown which is likely to happen. Could indicators like these hold the hand of the Fed? Or you think that is not happening in a hurry?
So I think there are two very clear distinctions. One, because in global trade, what you're looking at, there is also a very large base effect. So 1% will color the opinion because there is a very large base, so to speak. Secondly, the world GDP is not likely to grow at 2.5%, what global agencies are saying today, because when you look at the growth cohorts, I think the growth could be much lower. It could be close to 2% rather than higher. And 1% trade growth is in line with what GDP growth is happening globally. So it's not a really very surprising number when you look at the base effect as well. But I don't think Fed is too fixated on how global trade is moving right now. It is mostly fixated on giving a very, very clear forward guidance. Central banks utilize forward guidance or the way that they act, or it's a mental makeup, right? So they have to give a signal to the market that they are going to be fixated on inflation. As of now, that is their primary focus, and I think they will continue to have that focus for some time, unless and until they see very clear signs of data, which I told you earlier. I think once they see that the data, that trend is established, then possibly they will step back and say that we are going to wait for a while. Till that time, I don't think they're going to change their outlook, and possibly this change of heart or change of stance could come maybe by the end of 2022.
Right. Sahil, how are you looking at the prospect of emerging markets in the scenario where we are in global growth cycle, where we are on valuation front in developed markets, etc., and earnings prospects of emerging markets like India?
So Ajay, I think one thing is very clear that emerging markets are not expensive. They're actually hitting the cheap zone now. When you look at the data, which I put out just a few days ago, when you look at the MSCI Emerging Market Index, and if you look at the PE ratio, you will have to go back to the European crisis in 2011 or the global financial crisis in 2008 to find this price to earnings multiple for emerging markets. I think it's trading below 10 times right now. If you were to do an adjusted number, it will be trading even below 9 times. So emerging markets are cheap. Secondly, what we've seen historically, what happens is that emerging markets go through a very, very rough phase. When the global growth is slow or slowing. B, when global monetary policy is tight. Emerging markets find it very, very tough in that environment to grow. Both environments are there right now, which means that everything which can go wrong for emerging market is going wrong right now. The biggest comfort that you have for emerging market is the valuation part. And second and more important indicator right now is where the dollar is trading. We looked at data in the last 40 years. The dollar on a real basis, real effective exchange rate, hasn't traded above 112 level. I think it's a 40 or 50-year high when you look at the data. And there is only one precedence. You go back to 2000 and 2002 cycle where the dollar's rear peaked at 112 and then it started to decline. We are there right now. And the indicators that we watch to gauge the dollar strength, I think they're already hitting extremes, whether it's 2-year YOY change or the delta between hawkishness at Fed and the other central banks, or the delta between US growth and other trade competitors' growth. All the data points tell us that US dollar is in its extended cycle of strength and it is unlikely to last for a very long time. So if you put these two data points together, if the dollar were to weaken and you get a very cheap multiple at emerging markets, it makes emerging markets quite attractive. And I think when you put pecking order in terms of which asset class you want to put in your money today, and when you look at emerging market as a specific asset class, I think it surely gives you a very large amount of margin of safety.
One last word I would like to understand from you is the capex cycle. I was reading somewhere that we are actually entering a massive capex cycle. Not only India we all know, but globally too. In the next couple of years, one of the highest capex will be done, capital goods, etc., be in green, renewable, many other, just repair of infrastructure, older infrastructure in decades. If that indeed happens, how is the capital goods sector looking overall in India? The one which caters domestically and also looks overseas.
So Ajay, there are two separate things. One, I think in-house capex, which has got a lot to do with automation, which is, I think, a clear winner, at least for the next few years. Last 1 year, we've seen stock prices have behaved very positively. The overall sector has got re-rated. But barring that, I think there is a lot of opportunity in the capital goods sector. Domestically, even when you look at, let's say, the power transmission sector or the road sector or even the construction sector where home construction and building material comes in, or gas distribution comes in. And also, I think Ravi was talking about defense. I think all these areas are very, very critical going in the next 3 to 5 years. And most of these sectors are possibly aligned for good, well-established growth. We looked at some data and we drew a capital goods sector to Sensex ratio. And what is interesting is that in the decade from 2000 to 2011, the noughties between 2000 and 2009, in that phase, this ratio outperformed Sensex. That means this capital goods sector outperformed the Sensex, and it stayed above its one standard deviation the whole time. That means it outperformed the Sensex for a whole 10-year period. In the last 12 months, this is the first full 12-month period since 2009 that capital goods sector has again started to outperform. That means it has again started to re-rate. So when you look at bottoms up sectoral trends, I think there are enough opportunities, enough visibility, enough evidence that these sectors could do well over the next 3 to 5 years. And when you look at the statistical changes that the markets are telling you, I think it's a clear message from the market that there is something which has changed with the overall sector, and possibly you have to look at it more carefully. This cycle, I think, will be more bottoms up and more sector specific rather than being a very well broad brush cycle that we saw in the noughties. So you have to be more bottoms up in the overall theme. And maybe just one small point, I think also the global supply chains are getting re-established. Right now we are seeing world moving from a unipolar world to a multipolar world, different powers realigning globally. I think this will cause a large shift in global supply chains, and India will benefit definitely from it.
Right. All right, Sahil. Sahil, thanks very much for your time. Always enjoy our conversations.
Thank you, Ajay.
That was Sahil Kapoor.